Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news the trade war consequences are now starting to bite in economically significant ways. But first, Canada and the United States are in intense last-minute negotiations over NAFTA and seem to have narrowed their differences. But there is no certainty an agreement will be reached, according to various sources in Ottawa and Washington. A measure of the US dollar's influence internationally, the IMF's quarterly review of global foreign exchange reserves, shows a rather sharp fall in holdings of the greenback, down to 62%, and a sharp fall from over 65% at the beginning of 2017, and its sharpest fall ever. This data is on top of data showing the US is, for the first time, failing to attract foreign investment. In fact, there's a net outflow, and this will become a fast-growing problem for a country that runs huge deficits unless it's reversed quickly. In Canada, housing affordability is at its worst ever. It now takes an eye-watering 54% of household income to afford Canadian housing on average. It is much higher in Toronto, 86%, and Vancouver, 88%. And the situation is expected to get worse before it gets better because interest rates are rising there. In Japan, and in somewhat of a market surprise, retail sales there turned up strongly in August. Factory output data came in positive as well, and their unemployment rate fell to 2.4%. And new data shows that 70% of Japanese women of working age are now employed, a new high. In Europe, Italian stocks and bonds fell sharply at the end of last week as investors took fright over a fiscal stability package for a country that is continuing to weigh down European markets. The immediate cause is an October budget from an anti-establishment government that is Italy First, which has pledged spending and tax cuts that will likely put the country's debt on an unsustainable course. In China, the Caixin PMI signals a very sharp slowdown in Chinese factories in September. Outbound investment fell in August for the first time ever in China. Mostly that was a sharp pullback from investing in the US, but there is a redirection towards the EU. But the EU is also starting to push back. China is on its Golden Week holiday this week, and travel activity there will likely reach gigantic proportions. In Australia, their banks have been shamed for their sales culture, which bred greed, according to an interim report from the Royal Commission into Financial Services. But the long-running inquiry stopped short of recommending any penalties, sending bank shares rallying. The main sectors in the Hayne crosshairs are advisors and brokers, as well as insurers. And conflicts of interest in the way industry staff are paid are likely to change dramatically. But one important consequence of the Hayne report for banks is that they're going to be held responsible for borrowers' claims about their income and expense commitments. If a borrower or broker lies about that, it is the lender who will be responsible if they don't pick it up in their verification process. This is almost certain to slow approvals process to a crawl. Mortgage approvals are going to be very much slower. Sydney and Brisbane are on holiday today, and the US Treasury 10-year yield is at 3.07%. Their two-turn curve is now just under 24 basis points. And gold will start the week up $8, now at $1,192 an ounce in New York. US oil prices are up to just under $73.50 a barrel. The Brent benchmark is now just over $82.50 a barrel. And the Kiwi dollar is starting the week at 66.2 US cents. On the cross rates for a little change at 91.6 Aussie cents and at 57 euro cents. That puts the TWI at 70.2. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.